Vinit Sambre, who's joining us this morning. Vinit, we've been focusing on the kind of action we've been seeing across broader markets, with midcaps really being the flavor for the moment. Let's just talk about the kind of opportunity that you're seeing when it comes to the breadth of the market currently.
Good morning. Hi. Thank you for having me on the show. So, I think overall on the midcaps and the small caps particularly, the last 1 or 2 weeks we saw a good catch up taking place. They were underperforming earlier when the overall market started recovering. So I think that there's some bit of catch up trade, but generally my sense is that there has been some bit of higher optimism built around across various segments of the market. Even within mid caps, we particularly try to bifurcate between good and bad companies, good and bad businesses. But what we are witnessing in terms of the price action, there is hardly those differentiations taking place, so which actually worries us. But by and large, overall our current focus has been on companies, let's say within the healthcare space, which anyways, there's no big change in the portfolios as such. So we have been focusing on the healthcare sector. We have been focusing on some of the materials as a category. We have been focusing on auto as a category. Auto has been one of our slightly contra-cyclical bet, which we had taken exposure into. And we generally believe that the sector dynamics should overall go through a positive momentum over the next 2 to 3 years. We are not taking a short-term view. The prices have reacted. And we are a bit cautious on the banking sector. So I think broadly that's the construct. And one more theme, so consumer discretionary is one thing where we believe that the overall outlook is likely to turn better, but it will be a lagged recovery, I would say. Once we see normalization taking place, there is considerable amount of savings which has happened. People would want to go out and spend. So we believe some bit of exposure in the consumer discretionary is what we are trying to play through. So I think that's the broad construct.
Vinit, the space which you own for a long time is the specialty chemical space. 2-3 years ago, you bought into some of those names. But why are companies in the specialty chemical space now, or agrochemical space, commanding P multiples which some of the FMCG companies are commanding? These are B2B businesses. Suddenly markets are valuing them as if they are good brand businesses with great ROC and with great moats around them.
Yeah, so Nikunj, I heard your views a while back in terms of the expensiveness of the category. So let me tell you, so we have been owning these businesses not 3-4 years, but even longer. We actually took exposure in some of these companies way back in 2013-14. And we've been holding on to them, and we've seen the re-rating taking place. But generally, my sense is that whenever the sector comes into a fancy, that's how, the valuation spectrum moves from phase where people are neglecting the story, people are neglecting the those thesis, and it actually, the pendulum moves to a phase where there is euphoria, there is a lot of optimism built. And especially now in the current circumstances, what is also happening is that people are trying to focus on businesses which are relatively more resilient. And as we see these companies, if we go by the results which they are announcing, if we go by the strength of these businesses, I think there is a allocation of money which is taking place as people find comfort in terms of their earnings, visibility is looking better. And valuations is something which one will never be able to predict what will be the right valuations. We have seen segments which, trading in the, let's say, range of 10 to 20 times, also moving to 20, 25, 30 times. So I would say that it's very difficult to call at what valuation probably is, it will peak out. But my sense is that till the time the business dynamics are good, we would want to continue to own. We would more focus on the fundamental aspects. And once the fundamental weakens or the story, relatively looks weaker, then we may take a call on what has to be done.
Divide the market into a very simple formula or a very simple equation which perhaps everybody knows, but we don't pay too much of attention to it, which is market price is a function of EPS and PE re-rating. So let's talk about a pocket where you think EPS will re-rate the market price, and let's talk about a pocket where PE re-rating could re-rate the market price. It's a simple question, Vinit, very simple question, but perhaps the most difficult answer, isn't it?
I fully agree with you. The last few months, we have actually seen fundamentals having absolutely no bearing on what's happening to the markets and the valuations. It's been a bit of a crazy move. And like you said, I think eventually what we have observed, Nikunj, is that over a long period, it's finally the fundamentals are the biggest factor which eventually supports the valuations. So I would say that the people are still hoping, and the belief is that the India story beyond the COVID, beyond normalcy, would continue. The earnings momentum would eventually catch up, and which is where the deflection in the price. While in the short term, the factors which may play through will be even beyond the fundamentals. There's a lot of euphoria. Liquidity is so much. Liquidity has become a new fundamental. So I would say in the short term, these factors tend to vitiate the overall valuation spectrum. It tends to create the balance, and which is where probably the opportunity for the long-term investors to look at the excessive zones and try to play out from there. But like you said, I think investment absolutely is a very simple business. Go by the long-term fundamentals. If the earnings visibility is good, those businesses eventually will follow up good curve in terms of their prospects.
Vinit, you track the small cap space with a magnifying glass. Where within that are you sensing opportunities? Because there are many pockets within small caps which have given you great returns already. Sugar is a buzzing space. You've got auto anks performing really well, specialty chemicals, the agri theme. Many clusters as such are really holding out. Where within small caps do you find opportunities to invest in even now?
So, see, in terms of first of all, on the price point front, few segments have actually gone past their reasonable, let's say, valuation zones. But there are few categories which I would say are still relatively fairly valued, or I would say reasonably well valued. And these are segments, let's say, within the building materials, as a category where we have seen, because of the overall slowdown, the category momentum has not picked up. Then there are sectors within the textile industry overall, the home textile players, some of the branded garment players, they are going through a bit of a tough phase. But as we speak, the home textile players are witnessing some bit of positive momentum. So I would say relatively these are cheaper valuation spaces, and while in some of them the business momentum seems to be improving, some will take longer, and hence I would say that it's the time in the market which is going to determine how much returns one will be able to generate by investing into these categories. Definitely they are cheap for a reason. The visibility is poor right now, and once the visibility improves, I think these are the trades which should eventually turn out to be winners in future.
Sure. Okay, you touched upon financials and how they're kind of lagging there. What's the outlook on that front, Vinit, when it comes to some of the names, when it comes to mid-caps or the broader markets and the financial names?
Yeah, so see, clearly I think we all are aware the financial sector is going through a bit of a testing times, I would say. While some of them have been able to manage the affairs slightly better, if you look at the moratorium numbers and some of the other aspects. But I would say that it's going to be a tough phase for the lending businesses overall. But at the same time, I believe that for the banks which which have had a very good track record of maintaining high asset quality over a long period of time, I think for some of these banks, it would also mean that the current distress may be an opportunity to capture market share. So I believe that the banking has to be looked from that lens, that the challenging phase is going to be there for a year or so. And beyond that, the banks which are going to sort of look good are the ones which have had very strong, or good asset quality historically, and they have been capturing market share. So, as is generally known that if the economy has to grow, the banking sector has to support that. So I would say that be selective, be cautious within the banking space, but we would also like to be selective. We have reduced, pared down our exposure into the lending businesses overall, but at the same time we are focused on the banks which we believe would eventually gain and eventually turn out to be a better investment over longer term.
Okay, that's on the banks then. You talked about the kind of concerns, quality names that we're of course looking at, but what's a realistic return expectation, let's say from the mid-cap or small-cap funds, Vinit, going forward? Do you feel that this move that we've started to see is sustainable?
See, I would say that mid and small cap investment particularly, and I think broadly equity investment really needs a lot of patience and temperament, which I feel an average investor lacks, and which is where the mismatch between the expectation and finally what the returns are at. As I started saying that, especially in the mid and small cap spaces, we have seen that companies can remain in slumber for 3, 4, 5 years, and in a matter of 4, 5 months, the whole 4, 5 years return can get delivered. And we saw that happening across few names in our portfolio in the last 1 or 2 months. So I would say that these investments, they have the potential to deliver good outperformance over the large caps, let's say, over a long period of time. Only caveat being that investors need to exercise a lot of patience, and this, I would say, is true of the equity investment space as such. It's not a 1 month, 2 month story. These are businesses which takes time to grow. Many companies, as they start growing, the success begets success, and they keep growing larger and larger, which then starts getting reflected in terms of not only higher EPS, what Nikunj was talking about, but the PE also tends to get re-rated, and the maximum compounding happens towards a later stage. So I would say that buying into equities during a tough phase like now, while the valuations may look slightly on the higher zone, but over a longer term, I think these would definitely get ironed out, and we would see returns in sync with how the earnings will pan out eventually, and what ROEs and ROCs these companies would deliver. So I think that's where the investor should look at in terms of the anchor as to how the returns are going to look like in these categories.
Is it a good time to revisit autos? Because autos have had a poor 2019 and a terrible 2020. So the correction, in a sense, which we've seen in autos, and you mentioned that you are bullish on discretionary and durables, is auto the go-to space now? Because A, they are cheap, B, they don't have debt, and C, they've had like 24 to 30 months of a rough patch.
Yeah, I would surely agree to that, Nikunj. In fact, I mentioned in my initial remarks that we have enhanced our exposure in auto within the consumer discretionary basket. And the pure reason, like you were saying, is that they've gone through 2 years of a pain phase, and if we look at the auto numbers now, it is actually the whole sector has gone a decade back in terms of the numbers what they are delivering. So I think it's a pretty good low base which has got created. That's number one. Number two, the need for personal mobility and all these things is definitely going to drive much larger consumption as far as the auto is concerned. And also, we have one part of our country which is a rural side, which is still relatively doing better and is supporting in terms of the growth momentum. So I would say that all the factors probably are are in the favor of auto, while not calling out for an immediate turnaround. But I would say that the good and the base and all the factors are placed in their favor, and would like to see the auto sector do well over the next 2 to 3 years. That's our take.
You touched upon it, but let's get into that a little bit more detail, because we've seen a fantastic move coming in across most of those pharma names, and including, of course, the breadth in the broader markets as well. How bullish are you on this trend in pharma going forward and healthcare as a whole?
So I would say that while a large part of the optimism has really got captured in terms of the price point, so to anticipate similar or even a decent upside from here will be is not something which I'm going to sort of predict. But what I can say is that the sector dynamics are relatively looking much better versus what they were, let's say 2 years back or 3 years back. A lot of positive changes have taken place, both in terms of the abatement of the generic price pressure in the US markets. In India as well, the growth momentum generally from the lows which we had seen in the last 2 to 3 years, they are much better off. And third, because of the COVID and the China plus one factor, I think there is a lot of interest in terms of the API manufacturers. So I think that's the additional factor which is leading to some of the API guys doing well. And eventually it looks like India seems to be a relatively preferred destination when it comes to the pharma space, because not only that we have chemistry skills, but we are one of the lowest cost producers of their drugs globally. And as most countries, they embark on the journey of reducing their healthcare cost, I think generics is something which is going to be preferred. So I would say that the healthcare also as a category, I would say, is more of a non-discretionary in nature. If there is a need to consume healthcare, one has to go for it. So I would say that the sector dynamics tend to look pretty okay. The return expectation has to be a bit tempered, is what I can say. At the same time, within the broader healthcare category, I would say the healthcare service providers, which means the hospitals, laboratory business, which has faced quite a bit of a pressure in the last quarter. For them, the outlook is likely to change for better over the next 6-7 months, as we see that many patients who had postponed their elective surgeries, they would sort of come back. They would see better occupancy, and we believe that the healthcare service providers should do well going forward.
Very quick break on that note. Vinit, thanks so much for joining us for that extensive conversation on some of the trends in the broader markets.